In the world of borrowing money, a quiet but powerful revolution is underway. For generations, the path to securing a loan, car, a home, a small business led straight to the solid, often imposing doors of a traditional bank. The process was familiar, if not always fast. It involved paperwork, face-to-face meetings, and a long, anxious wait for a decision from a loan officer. This established system, built on decades of financial practice, has long been the gatekeeper of credit, deciding who is creditworthy and who is not based on a well-worn set of rules and historical data. But now a new challenger has stepped into the ring, and it doesn't have a corner office or a firm handshake. This challenger is artificial intelligence, or AI. It operates not in marble-clad lobbies but in the silent, humming servers of fintech companies and increasingly, within the digital back offices of those same traditional banks. AI promises a different experience, faster, more efficient, and potentially more inclusive. It claims to see a more complete picture of you than a simple credit score ever could. This technological shift is forcing a fundamental question for every American borrower. When you need money, who will approve your loan first, the algorithm or the banker? The answer to that question is far more than a matter of convenience. It has profound implications for your financial future. When you walk into a traditional bank to apply for a loan, you are initiating a process that has been refined over many decades. The cornerstone of this evaluation is your credit history, a detailed record of your past borrowing and repayment habits. The bank will pull your credit report from one or all of the three major credit bureaus: Equifax, Experian, TransUnion. These reports contain a wealth of information: payment history on credit cards and other loans, the amounts you owe, the length of your credit history, and any recent applications for new credit. It's a financial biography written in data, and the bank reads it carefully. From this report, the bank focuses heavily on your FICO score. This three-digit number, typically ranging from 300 to 850, acts as a summary of your credit risk. A higher score suggests you are a reliable borrower, while a lower score signals potential risk. Banks have established cutoffs for different types of loans. For example, a prime mortgage might require a score of 740 or higher, while a personal loan might be available to someone with a score in the high 600s. This score is paramount. It often serves as the first gate you must pass through. If your score is too low, your application may be rejected outright before any other factors are even considered. Beyond the credit score, the bank's loan officer will manually verify other critical pieces of your financial life. AI credit scoring represents a radical departure from the traditional model. Instead of relying primarily on your past credit history and FICO score, AI systems aim to build a much broader, more dynamic picture of your financial identity. These systems are built on machine learning algorithms trained on immense volumes of data. The goal? Identify subtle patterns and correlations that predict a borrower's likelihood of repaying a loan, patterns traditional credit reports might miss. The AI doesn't just ask, "Have you paid your bills on time in the past?" It asks, based on thousands of data points, what is the probability you will pay this specific loan back in the future? The data sources used by AI are far more extensive than those used by traditional banks. Traditional credit bureau data, real-time income and cash flow utility, payment history, rental payments, educational background, employment background, shopping, and transaction history, website or app interaction behavior. The system finds signs of financial stability wherever they may exist. The core of the AI model is the algorithm itself. This isn't a simple checklist. It's a self-improving system. It processes more loan applications and observes outcomes, repaid or defaulted, and refines its understanding of risk. This is the machine learning aspect. If the AI discovers maintaining a certain minimum checking balance signals reliability, it will give that factor more weight in future decisions. The most dramatic difference between AI and traditional banks is the speed of loan approval. The data paints a stark and undeniable picture. For traditional banks, the loan approval process is measured in days and weeks. According to the Federal Reserve's 2024 Small Business Credit Survey, the median wait time for a decision from a large bank was about 15 to 21 days. For approved applicants, application to funding averaged 30 to 60 days. This timeline can feel excruciating for a business owner needing capital for payroll or inventory. The story is similar in the mortgage market. Ellie Mae data shows average time to close a mortgage around 45 to 50 days. The initial pre-approval might come in a few days, but that's just the start. Underwriting, appraisal, final verification. For a personal loan from a traditional bank, expect 1 to 7 business days if you're an existing customer with strong credit. Now, AI-powered lenders, their numbers are measured in minutes. Upstart and SoFi often give instant decisions on personal loans. A 2024 Cornerstone Advisors report found nearly 70% of Upstart loans were fully automated and instantly approved. For many, funds can arrive in as little as 24 hours. The initial decision often arrives in under 5 minutes. Even for small business and mortgage lending, AI cuts wait times drastically. Fundbox and Bluevine can approve and fund a business line in as little as 1 business day, sometimes within hours. They do this by analyzing accounting software and bank accounts in real time. Rocket Mortgage has advertised approvals in as little as 8 minutes. Full closings still take time for legal and appraisal reasons. But the AI underwriter's initial, binding approval is a speed traditional banks can't match. So, embarking on the journey to secure a loan, it unfolds in 2 vastly different ways. Bank on the left, fintech on the right. The traditional bank process is document-heavy. It often starts with a conversation, or an online form. Then you submit lots of paperwork, gather W-2s, recent pay stubs, federal tax returns for the last 2 years, statements for all your bank and investment accounts. If you're self-employed, you'll need profit and loss statements and balance sheets. After submission, your file is assigned to a loan officer. The loan officer reviews your application. They may call with follow-up questions, or request more documents. Then the file moves to underwriting. An underwriter dives into your finances. They verify income, they verify employment, they verify assets. Documents move from your hands, to the loan officer, to the underwriter, and possibly back again. That back and forth creates a long, opaque timeline. The AI-powered journey is the opposite, fast and simple. The whole process happens online, on a website, or on a mobile app. You fill a short form with basic info. Then you grant secure, read-only access to your primary bank via a service like Plaid. That single connection lets the AI analyze income, spending habits, and cash flow, all without you uploading pay stubs or bank statements. It automates verification that would take humans days. You click submit, the AI takes over. In seconds, it processes your digital footprint, compares it to massive datasets, and calculates a risk profile. So, let's consider the story of Sarah, a 28-year-old freelance graphic designer living in Austin, Texas. Sarah needed a $15,000 loan to invest in a new high-performance computer and a software suite which would help her take on more lucrative video editing projects. As a freelancer, her income was, well, inconsistent. Some months were great, but others could be pretty lean. Her FICO score was a decent but not spectacular 690, mostly because she only had 1 credit card and a couple of old student loans on her record. She knew that walking into a big national bank would be an uphill battle, with lots of paperwork and, honestly, a good chance of rejection. Instead, Sarah turned to an online lender that uses AI for its credit scoring. She started her application on her laptop at 9 o'clock on a Tuesday night. The process was refreshingly straightforward, just her name, address, and the purpose of the loan. The real turning point came when she was asked to link her business checking account. She paused for a second, a bit concerned about security, but the platform used a well-known data aggregator, which gave her some peace of mind. So she securely logged into her bank through the portal. This allowed the AI to see 2 years of her transaction history, spotting a steady pattern of client payments, even if they didn't always arrive on the same day each month. The AI's analysis went way beyond her 690 FICO score. It noticed that Sarah never overdrafted her account, kept an average daily balance of over $3,000, and had deposits from several recurring clients. These were all signs of strong financial management and a reliable, if non-traditional, income stream. While a human underwriter might have been wary of her freelance status, the algorithm picked up on positive cash flow patterns that, in its historical data, correlated highly with loan repayment. It basically looked past the gig worker label and saw a credit-worthy individual. At 9:05, just 5 minutes after she started, the screen refreshed with a message. "Congratulations, you're approved." Sarah was offered a $15,000 loan with a 3-year term, and the interest rate was competitive. She reviewed the terms, e-signed the agreement, and provided her bank details for the deposit. By Thursday morning, less than 36 hours after she'd first thought about applying, the full $15,000 was sitting in her checking account. For Sarah, the AI system wasn't just faster. It was the only system that could truly understand her modern financial life. Now let's look at what happened for Mark and Jessica, a couple in their mid-30s, who wanted a home equity line of credit, $50,000, to renovate their kitchen. They'd been loyal customers of their local community bank for over a decade, mortgage, checking, savings. Mark had a stable job as a teacher, and Jessica worked part-time as a nurse. Their credit scores were both excellent, in the high 700s, and they had a lot of equity in their home. On paper, they seemed like perfect candidates, so they figured the process would be pretty smooth. They made an appointment and met with a loan officer named David on a Monday morning. The meeting was pleasant. David was friendly and assured them they were strong applicants. But then he handed them a thick application packet and a long checklist of required documents, 2 years of tax returns, 60 days of pay stubs for Mark, 60 days of pay stubs for Jessica, quarterly statements for their retirement accounts, and their most recent mortgage statement. It took them the entire week to gather, scan, and upload everything to the bank's online portal. The following Monday, a full week after their initial meeting, they got an email from David confirming all documents had been received and sent to underwriting, and this is where the waiting really started. The underwriting department was backed up. After 10 days of silence, Mark called David for an update. David was apologetic but explained that their file was still in the queue and an underwriter hadn't even been assigned yet. Another week went by. Finally, they got a notification. The underwriter had a question. There was a one-time bonus on one of Mark's pay stubs from 3 months ago that made his income look higher than usual. They needed a letter from his school's HR department to confirm it was a one-time payment, not part of his regular salary. When you're deciding between a fast AI lender and a slower traditional bank, you're facing a clear trade-off between speed and other important factors. AI's biggest advantage is speed and convenience. Getting a decision in minutes and funding in a day or two, life-changing for emergencies or time-sensitive opportunities. Plus, AI's use of alternative data is a huge pro for people with thin or imperfect credit files, freelancers, recent immigrants, young folks. The AI can spot financial responsibility in ways a FICO score just can't. But speed and automation do come with real risks. The main concern is transparency and fairness. These complex algorithms are often black boxes. Even the companies that build them can't always explain exactly why a particular decision was made. That makes it tough to challenge a rejection or figure out what you'd need to do differently next time. There are ongoing worries these algorithms could reinforce or amplify existing biases. An AI trained on historical data might end up discriminating against applicants from certain neighborhoods or demographic groups. Traditional banks, on the other hand, offer the benefit of human interaction and clearer regulatory oversight. If you're denied a loan, you have the right to an explanation, and you can often talk directly to a person to understand the reasoning. A loan officer can sometimes advocate for you using judgment to approve someone who doesn't check every box but has a compelling story. The downside, of course, is the slow pace and a pretty rigid reliance on traditional metrics. If your FICO score is low, it can be an automatic no at many banks, even if you have high income or big cash reserves. For borrowers, it's all about weighing these pros and cons. So, who approves your loan first? The evidence is overwhelming, and honestly, the truth is pretty clear. AI-powered systems are exponentially faster than traditional banks. It's really not even a close race. Where banks take days or even weeks to slog through paperwork and human reviews, AI algorithms can deliver a decision in just minutes. This speed comes directly from automation and the AI's ability to instantly analyze mountains of digital financial data, skipping over all the manual verification steps that slow down the traditional banking process. For today's borrower who needs capital now, AI is the undisputed speed champion. But this win in speed doesn't automatically make AI the best choice for everyone. The future of lending probably isn't going to be a total AI takeover but more of a hybrid model. We're already seeing this happen. Traditional banks, realizing they can't keep up with AI's speed, are starting to bring AI into their own underwriting processes. The bank of the future might use an AI engine for the initial rapid assessment, freeing up human loan officers to focus on more complex cases or to provide personalized advice and customer service. The stuff algorithms just can't do. That could actually give us the best of both worlds. For you, the borrower, this changing landscape means more options and more power. You'll be able to pick the path that fits your needs. The lightning-fast, fully automated route for urgent and straightforward loans, or the more guided, human-centric path for complicated transactions like a mortgage, where advice is just as valuable as the money itself. The growing use of alternative data by both fintechs and banks will hopefully lead to a more inclusive financial system, where people are judged on their real financial habits and not just an old 3-digit score. In the end, the incredible speed of AI has forced a century-old industry to pick up the pace and become more efficient and customer-focused. While we do need to manage the risks around bias and transparency, the direction is clear. The future of your wallet is going to be a partnership between human judgment and artificial intelligence, working together to get you the money you need, not in weeks or days, but at the speed of modern life. And in that race, the real winner is you, the informed borrower.